Very good. Good afternoon, everybody, and welcome to today's webinar. My name is Christophe Künzler. I am co-chair of the Professional Learning Committee and your host for this presentation today. Today, we want to shed light on a significant yet less known segment of the Swiss ecosystem, the non-profit sector. We will focus on foundations and the way they invest their capital with both an academic and very practical perspective. We are very pleased to be joined today by our two experts of the matter, Sara Stühlinger and Antoine Veyrassat. Sara Stühlinger works as a research assistant at the Center for Philanthropy Studies at the University of Basel. Her research focus is non-profit financial management and impact investing. She has contributed to several publications on impact investing, as well as to the Yearbook of Swiss Charities. Antoine Veyrassat is a senior portfolio manager at Fondation Botnar, also based in Basel. He oversees asset management and the foundation's contributions to impact investing by building a purpose-related investing discipline. The presentation will be followed by a Q&A session, so please feel free to submit your question via the Q&A tool. We will address them after the presentations. Dear Sara, the floor is yours.
Thank you very much, Christophe. I will start to share my screen. Okay, thank you very much, Christophe, again, for the nice introduction. I'm very happy to be here today and talk a little bit about foundations and how they can achieve impact with their investments. However, I will start a bit with a general introduction about foundations and the sector, then go on to tell you a bit about characteristics of foundations, because depending on what kind of foundations we talk about, also how they invest might differ a little bit. And then in the last part, really talk more about different approaches, how foundations can invest and link investments and impact. Foundations are autonomous legal entities, which means that they are independent from the founder. But they are not only independent from the founder, they also have no owners and no members, and as such, they miss kind of a control body, and therefore the foundation supervisory authority, which is either depending on the foundation, on a federal, cantonal, or local level, is in charge of this task. Another very important characteristics of foundations is the immutability of their mission, which means that it is very difficult or even impossible to change the mission. There is an exception, that's why I say very difficult, but for now, just remember it's difficult or very, very difficult. Then we have foundations which are charitable and foundations which are not charitable. Today, I will focus on the foundations which have a charitable mission, and as such, they are tax exempt, not from all taxes, but from many. When we look at the development of the foundation sector over the last 30 years, it's quite impressive how the number of foundations increased. This graph is from the yearly published Schweizer Stiftungsreport, or Rapport sur les fondations suisses. And if you look at the axis on the right-hand side, you see that the number of foundations where the line starts is a little bit below 6,000, and it goes to more than 12,000 or even more than 13,000 by the end of last year, which means that the number more than doubled. The bars represent the number of establishments, and as you can see, I would say like for the last 20 years, there were a couple of years with a bit more establishments and less, but it's more or less stable. As I already said, the mission is very important as it is set with the establishment of the foundation and is hard or impossible to change. And therefore, it's interesting and quite stable, the distribution of mission in certain areas. And the foundation can have a narrower or larger mission spectrum, and therefore the bars, if you add them up here, they amount to more than 13,000. So some foundations are active in more than one area, and the most common areas are culture and recreation, social services, and education and research. I already come to the second part of my presentation, where I will tell you a little bit about different types of foundations. And there are a lot of different characteristics how you can distinguish foundations, also such as who's the founder, or yeah, in which mission area they or field they are active. But two very important characteristics for me are the income model and the expense model, especially if we talk about investments. So the income model is kind of obvious because that's how they earn their money, and some foundation, the financial returns from investments are really the main income source, whereas for other foundations, they generate their revenues through, for example, donations, but I would also subsume all other foundations now under this broad term of fundraising revenue, or this category here, like if a foundation earns its money through revenue contracts, etc. On the other end, or on the other side, we have the expense model, so how the foundation spends its money. And there we can broadly distinguish between grant making and own projects. Grant making means that the foundation gives away grants, and organizations or people apply for these grants, or they are looking for grantees by themselves. Own projects might be that they, for example, run their own museum or have a botanical garden or a nursing home. So there are a lot of different areas where you can have their own project, where you can have your own project. This is for sure very, let's say, like dichotomous here. So the reality, and I'm very aware of that, is much more complex. And you might be aware of a foundation which doesn't really fit in any of these boxes I will now present, but it might give you a bit of an overview on what is meant when we talk, for example, about a grant-making foundation. Because often when someone talks about a grant-making foundation, they talk about a foundation which has an endowment and generates their revenues from financial investments. When we talk about operational foundation, it's not as clear. I feel my experience is that it can then be both. There is some operational foundations which have an endowment and to a large extent rely on financial returns, but there are also operational foundations, or many, which rely on, for example, donation revenues. I also put down a box with fundraising foundations, because that's often used too, and there it's clearly an organization which relies on fundraising revenue. And as a last box, I wrote down philanthropic intermediary. Sometimes the word philanthropic intermediary is even used for foundations in general, but here I would apply it in a bit more narrow sense, in a way that I think of it as an organization which raises funds, maybe from like private people, and gives it on to project other people. So it really, the foundation there is really an intermediary. And this distinction is especially important because if financial investments are the main income source, foundations invest normally a bit differently, I would say, than if it's a side income. And I will show you an example of fundraising charities in a minute. But before that, I tell you a bit about foundations as investors, because I think what is important to know here is that the responsibility for the investment process and the investment strategy and the evaluation, monitoring of it lies with the foundation board. For sure, larger organizations which have staff management it might be prepared by management, but the eventual responsibility lies with the foundation board. They have to follow legal and economic principles, although they're not strictly bound to the requirements for the pension funds, like the BVV2 or OPP2. I think more important in the foundation context is that it is in line or kind of with the authorities and with the foundation deed. So for example, if the foundation deed says you're not allowed to have more than 50% in shares, then this is set in the foundation deed and you have to respect that in your investment strategy. Then I've slowly come to the topic of impact. In the Swiss Foundation Code, it's written that foundations should not only be seen as doing impact in their grant making work, but should be seen as a unity of impact, which means that impact also plays an important role, or should play at least a role, and be considered in the investment process too. For example, through principles of sustainability or mission investment. I talk about mission investment in a minute, but before that, let me show you the example of fundraising charities, which I announced a bit earlier. And here, these are the numbers from the yearly published Jahrbuch der Hilfswerke. And compared to what I talked about before, where I really only talked about foundations, this Jahrbuch or yearbook analyzes not only foundations, but also associations and a few organizations with other legal forms. But I think this doesn't really matter here so much, because what matters here is that they're all looking for funds. So they do fundraising activities. And as a result, investment income is often only a side revenue for them. And what is more important for them is that they kind of, let's say, not gamble with the money they get from the funders and the donors. And this is really reflected in how they, or how their financial assets are distributed. So you see they hold a lot in liquid assets, and even among the securities, there are some bonds and a lot of other financial investments, but these other financial investments are, as far as we can tell, not to a large extent like high risk investments that might also be loans to another charity, etc. And yeah, as you can see, the conclusion here is really they invest with a low risk, but financial returns are also just a side revenue. Whereas the certain strategy, especially the last approach I will present you, this is more an approach for grant making foundations. But before I come to venture philanthropy, this will be the last approach I will present you. I want to talk really briefly about two other approaches. I already mentioned mission investing, and mission investing, or also mission related investing, it is sometimes called. As the name already reveals, it's the link, or it's to link the organizational mission and the income model. There are various ways how you can implement that. Like maybe the first step is often to do negative screening and then maybe positive screening. It can also be that you do shareholder advocacy, for example, that you have a dialogue with the company you invest in, or that you do proxy voting. Then the last possibility to implement it is proactive mission investing, which is often done via impact investing. And impact investing is not really, at least the definition of impact investing is not different to foundations than to other investors. So I also use here the often used definition or description of impact investing, that it aims for a measurable and intentional social and financial return. However, what might be a bit special or important for foundations is that if there is a trade-off, and I know especially for financial, or let's say if you trade off financial return because you want to have more social return, then there is always this weighing up if this is worth giving up the financial return, and also that you have to check if this is in line with the foundation deed, with authorities, etc. So this might be a bit of a difference between foundations and maybe other types of investors. I also wrote down here 2 examples. Just briefly, maybe climate bonds, that's something you all heard of. But for foundations, a way to do impact investing can also be that you rent out real estate to projects which are in your field of the mission and active in there, and you give them, you rent it out to below market rent. If you want to learn more about these examples, you can find them in a recently published practical guide on impact investing. You also find all the references in the end of my presentation, so you can look that up and read more about it if you are interested in it. So the last approach is venture philanthropy. And as I already mentioned, this is probably really an approach which is to a large extent done by grant-making foundations. And here the goal is really social impact. It might include, but not necessarily include, a financial return. But what is more important here, and the crucial criteria, is really that it is a long-term and high engagement commitment, and you might share your networks with the investees or grantees. So these were the 3 approaches I briefly wanted to talk about. And this leads me already to my final remarks. As we've seen, there is an increasing range of possibilities for foundations to achieve impact and implementing the mission. So venture philanthropy and impact investing are both still rather recent approaches. This leads to a lot of opportunities, but also some challenges, especially, I would say, in the fields of competencies, but also some legal challenges, but also that you find investees which fit your mission, etc., can be a challenge. And maybe as a last remark, also to link it a little bit with the first part of my presentation, foundations are very diverse, and so are their investment and grant making strategies. So what might be right or a good strategy for one foundation is not necessarily an ideal strategy for another foundation. It really depends on the foundation. And as I told you, here you find all the references if you're interested in learning more about these topics. And that brings me to the end of my presentation. I thank you very much for attending this first part of today's webinars, and I directly hand over to Antoine and look forward to your presentation. Thank you very much.
Okay, thank you. So I will start sharing my screen. Okay. All right. So I'm very happy to be here at this webinar, and happy to present how we do impact investments, how we generate impact through our investments. First, let me start with a quick introduction to the foundation. So the name is after Octav Bodnar. He was from Romania, a communist in his early days. Later, Octav fought in the French resistance during the Second World War. And after that, he became a successful entrepreneur in the auto business, built up an auto empire in the UK by importing Datsun cars, which became Nissan, and then also building the whole infrastructure around this auto import business. That was followed by a tragedy in 1972. His only child and daughter, Camilla, was killed in a car accident. And following that event, he became one of the leading philanthropists in the UK. Himself, he deceased in 98, after which his wife, Marcella, then in 2003 created the foundation with the aim of helping children in need around the world. And it is only after her death in Switzerland in 2014 that the foundation was the sole beneficiary of her inheritance, which led the endowment to climb to over 3 billion Swiss franc. So it's only 3 years ago that the foundation board, there was only a foundation board at that time, that they recruited a CEO and started to establish a management office here in Basel in Switzerland, which brings us to today. We are a team of 17 and 3 trainees. According to the deed of the foundation, the purpose is to support children worldwide across health, nutrition, and education. But more recently, we have refined this purpose of the foundation, thereby focusing on the well-being of young people in urban environment in lower and middle income countries. Our investment activity is guided by an investment policy and by investment beliefs and principles, which just underscore the importance of best practice, best institutional practice in asset management. The investments are overseen by the CIO and myself, and there is an investment committee in place, which consists of 2 board members and 2 external members. We have a rather long investment horizon of at least 50 years, as the activities of the foundation are supposed to last at least for such a long period. And the investment objective is to deliver 2% average return per annum, which is consistent with the risk tolerance of the foundation board. We also manage liquidity, obviously, in order to be able to fund grants. And the currency allocation mirrors our expected currency needs on the grant side. So it's approximately 30% each US dollar, euro, and Swiss francs. For liquids, traditional asset classes, we prefer indexing strategies, as we believe that only very few asset managers are able to consistently outperform their benchmark sustainably over a long period of time. And one of the important principles is that we invest responsibly. So we aim to have long-term financial returns, but as a foundation, we seek to harmonize the investments to a certain extent with the goals of the foundations. So as Sara mentioned, foundations with philanthropic missions sometimes call it mission-related investments. So therefore, we look at ESG criteria. We have 2 beliefs. One is that responsible investing enhances long-term risk-adjusted returns. So this would be the value dimension. And on the other hand, responsible investing also creates long-term positive value for the society and the environment, which is the values dimension. On this slide, you can see the SAA, the long-term strategic asset allocation, and the return of the fund and its benchmark. So the SAA is approved by the board. It has 52% allocated to equities and 44% to bonds. So we are unlike the average foundation that was pictured in the last presentation. It's a risk-seeking allocation, but we have a long-term horizon. The assets or different asset classes are constrained by lower bands and upper bands, which is the basis for our rebalancing policy, which is simple and anti-cyclical. As we also favor simplicity, we have kept the portfolio streamlined with only 5 external managers and 10 mandates. All the money is managed externally. All strategies are indexing strategies, which seek to replicate the performance of market indices. And given that we don't have yet any alternative strategies in place, the total expense ratio is rather low with 12 basis points. As one can see, there is a placeholder for impact investing, 3%. That's the first alternative asset class that we are in the process of building up, in the process of ramping up with a long-term target of 3%. And the average return has been slightly north of 5% since inception, which was in February 2017, which obviously is a very short period and was mainly driven obviously as well by equities. So this slide gives an overview of the range between traditional investments and purely philanthropic donations. In the middle, we have responsible investments and our impact investments, which have the objective, as mentioned, to achieve a certain harmonization of the investments with the goals of the foundation. So responsible investments focus primarily on avoiding a risky ESG practice or rewarding positive ESG behaviors, and impact investments on the other side aim to achieve positive measurable impact in an intentional way by investing in purpose-led organizations. And for those two buckets, the returns that we pursue are market rate returns, which are consistent with the risk tolerance of the board. Responsible investments are based on our two beliefs that I mentioned previously, but they can also be looked at as being part of risk management, looking at the different ESG risks that there are, or on the other hand, to target a certain minimum quality of the portfolio in terms of ESG factors, similar as one would have a minimum credit rating for a corporate bond portfolio. We have three pillars how to implement responsible investments. The first is ESG integration in indexing strategies. We therefore use ESG benchmarks or ESG universes. One example would be using the MSCI World ESG Index benchmark, which takes the standard MSCI index as its parent index, but then just keeps the best 50% of the best rated in terms of ESG ratings, best rated companies. So this would be a best-in-class benchmark. The second pillar is the exclusion of issuers involved in controversies related to child labor. This is done across the portfolio, obviously excluding governments and Swiss real estate. This makes sense looking at our purpose of the foundation. So we felt it necessary to have certain exclusion criteria for at least for the corporate bonds and equity portfolios. And the last pillar is active ownership. It's stewardship, basically voting and engaging with companies, having a dialogue. And we do this for corporate bonds and equities, and this is performed through Hermes Equity Ownership Services, which is a well-known stewardship provider. So impact investments go a bit further than just responsible investments, than ESG integration, exclusions, or active ownership. They aim to achieve positive impact, measurable impact, be it social or environmental, with intentionality by investing in purpose-led organizations. And those organizations, they create impact by selling products or services that serve the needs of underserved populations, or that maybe also help solve environmental problems. As mentioned before, we are in the process of building up two mandates, targeting 3% of the assets. Why only 3%? It may seem small. For us, it's a large enough size to allow for customized mandates, to have access to those two managers' know-how in terms of impact investing. And it is small enough, taking into account the lower liquidity and the higher risk, and also the limited capacity of impact investments. The geography will be in emerging and frontier markets, and so aligned with the foundation's geographical focus on lower and middle income countries. Each mandate will have at least 70% in private equity and up to 30% in private debt, and that will be achieved both through fund investments and as well direct investments. We have selected 2 managers, and this was an internal search exercise to maximize our learning benefits related to impact in investing. The 2 managers are Oviam and Partners Group Impact Investments. Oviam is an independent company, but the manager of the Swiss Investment Fund for Emerging Markets, also called SIFEM AG, which is basically the Swiss Development Finance Institution. And PGII is an impact investment manager, which was founded only 5 years ago as a foundation, but it is backed by its bigger brother, the company Partners Group. Moving on to the next column on the right. So to achieve purpose, which is the well-being of young people, we have so far been using only traditional grants to mainly non-profit organizations. So this new pillar, venture philanthropy, will extend our grant instruments, and it will complement those with purpose-related investments in for-profit businesses. So we call them also market-based interventions or program-related investments, as they would be called in the Anglo-Saxon world. Venture philanthropy can be seen as a bridge between traditional mainstream impact investments and traditional philanthropy. In contrast to responsible investments and impact investments, venture philanthropy investments are situated on the grant side. So they will not be part of the SAA or the endowment assets. However, obviously they will figure on the balance sheet. Purpose-related investments, as the name suggests, they must be aligned with the purpose of the foundation, obviously, which is the well-being of young people. And for those investments, impact is not just a byproduct, but it's the primary objective. And returns can be below market. Obviously, we will strive for returns, but we take into account that those can be below market or concessionary, as the investment sizes are very small and the costs to perform due diligence, structuring of the transactions, and so forth are quite high. So the net returns will most probably be rather low. We are in the process only of formulating this strategy, and we are evaluating partners who will help build us such a venture philanthropy portfolio. So the foundation deed already laid the basis for purpose-related investments by saying that the foundation may establish or acquire shares in companies. However, there was one obstacle, as we are a tax-exempt foundation, because we have a charitable purpose. And so such a charitable purpose is generally not consistent with program-related investments or purpose-related investments. Such investments could be seen as a commercial activity. So we have been talking with our law firm for quite some time, and we had to seek dialogue with the tax authority, the Canton Basel-Stadt in our case, in order not to lose our tax-exempt status. And we had a good discussion. We obtained a ruling which opened the door to purpose-related investments, but obviously under certain conditions. So those investments need to be direct investments. They couldn't be just fund investments or so-called indirect investments, which could be regarded as being part of the financial assets. Also, such purpose-related investments need to be of subordinate nature. They are part of grant making, but grant making, which is à fond perdu, should still represent the bulk of our giving. Income, for example, of those investments should not exceed 20% of the total income of all financial assets. And activity outside of Switzerland is acceptable as long as it is limited to the developing countries due to the Swiss humanitarian tradition. So our future investees in that strategy, in the venture philanthropy strategy, they are for-profit, social businesses, social entrepreneurs, which apply business models that help to drive our purpose. So by providing value to their customers through different products and services. The preferred business lifecycle entry point for us would be proven startups at an early growth or expansion stage. So that's just between seed stage and later expansion stage. Proven business model, meaning that the business model has been validated through initial sales potentially. But you can call this the missing middle, because entrepreneurs often fail at this stage because there's a lack of financing options. It is also called the valley of death. The businesses at this stage are, on the one hand, too big to be eligible for microfinance, and on the other hand, too small to be a member for a recipient of traditional finance. So the objective here is to support our investees grow, reach economic break-even, sustainability, so that they can scale their impact and drive our purpose at the same time. For us to be an investor, investees must formulate a plausible medium-term path to economic sustainability, to break even, and products and services obviously are expected to be priced at market levels. On the other hand, we want to avoid putting pressure on social entrepreneurs so that they quickly reach break even. We are not in a hurry, and they shouldn't do that at the expense of their social mission. Also, our investments are so-called, or represent so-called patient capital. We have a long-term investment horizon for that strategy, which is between 5 and 10 years. Obviously, we expect our investees to follow sound ESG practices that will be looked at in detail as we do for our traditional bond and equity investments. Hence, we cannot do that alone. We are only 2 people on the investment side of the foundation. So we will need to be working with outside partners to do the sourcing and the due diligence of potential investees. So they will act as advisors or managers, have the necessary know-how, local presence, obviously boots on the ground, and have skills and experience in sourcing and performing due diligence. We are also open to use different financial instruments at the different stage of the business life cycle. This can range from recoverable grants up to equity. So this brings me already to the end. So I guess this summarized how we want to invest in order to have impact, and how investments can achieve impact all the way from mission-related investments to venture philanthropy. Impact investments are certainly quite needed across our planet, and I'm convinced that the foundation sector could play an even bigger role, could leverage its impact if they started to do venture philanthropy and impact investing even to a greater extent. I think the cost aspect is important, the risk aspect. Foundations can afford to bear risk, to move into a risky territory, and they can afford the cost. So I think they are well placed to perform this role. What is still required, on the other hand, is maybe some more flexibility from some cantonal authorities to recognize venture philanthropy as part of foundation missions. Because of this tax exemption, many foundations are still hesitant to perform such investments. So Basel-Stadt has favored our strategy, but there are many other cantons which are maybe more difficult to talk to.
Thank you very much, Antoine. Thank you, Sara. So I think you raise an interesting point, Antoine, and probably also one of the characteristics of Switzerland and the federal system. How, and this is maybe a question for, I mean, for both, but also for Sara, how do you assess Switzerland and each location as being attractive for your mission? I mean, is Basel particularly advanced, or is it more a function of you being there and that you have made the frontiers, the lines move, or how is Switzerland in the respect for advanced foundations like yours?
I think Basel has only started. There are a few foundations, and Basel is well known to be a city where there are many foundations historically, and we have Sara in Basel as part of this center for philanthropic studies. So I think Basel has had some experience with some foundations doing impact investments. Zurich is quite open, and then I know that Schwyz is open as well, but there are other cantons which are more difficult, like Bern. So this is an ongoing dialogue, I think, across Switzerland.
Okay. And I would also say it's a rather, like, the topic in general is rather new still, so we will also see how it evolves over the next couple of years. Yeah, I think, I mean, impact investing, depending on where you see the starting point, but let's say as what we see it today is about 12 years old, so we will see how it evolves and how that will change. And I mean, for a lot of foundations, it's also that, I mean, one thing are the authorities, another thing is also their foundation deed, which might be a factor which allows certain things or limits it in other ways.
This leads to one of the questions we have actually from the audience, from Johannes Schwan. I think he was looking for some clarification about coming back to Sara, to the asset management or asset management of foundation. Typically, of course, we see foundation, but now is probably the 3.0 version of managing an endowment. How would you qualify in your experience the way the money is being managed in foundations in Switzerland?
I mean, that's very difficult to say. So to generalize that, because I think my final remark was really like foundations are different, and I tried also to show a little bit, and I hope, especially after Antoine's presentation, it becomes very clear that there are a lot of different foundations, and like this distinction between foundations which raise funds and foundations which have an endowment, I think is really important, because the ones which raise funds and normally invest with low risk, they might do impact investing as well, or have certain approaches implemented too, but to a limited extent, because also it's not their main area of activity, I would say. They often have their own operations, they have their projects. So, I mean, this is already an important point when it comes, and also there's not really a database where we see how the foundations invest. The example I showed with the Jahrbuch, these are all organizations which which have a quality seal, the CEBO certification, and as such they publish their annual reports. And but these are all fundraising charities, so this is a bit different than the grant making or endowed foundations.
Okay, we have a question here from Ratanatra. A question to Antoine: in philanthropic ventures, do you only finance companies, so their balance sheet, or also specific projects that may yield a financial return in the long run?
So the focus is on companies. The grants do finance certain projects. That's true. Always aligned with the purpose of the foundation, but for the venture philanthropy strategy, we certainly target companies, small businesses, venture startups, which are based obviously in our focus countries, Ghana, Senegal, Tanzania, Colombia, those different countries which have been selected. Therefore, we need serious partners to have a joint investment discipline, to do the due diligence, co-invest potentially, but those are all will all be private companies, startups, and always private equity or private debt.
What's your time horizon for an exit?
It's 5 to 10 years.
This project.
Yeah, it's 5 to 10 years. It's still difficult to tell. Probably debt investments can be shorter term. Equity investments can be longer term. Potential exit strategies could be selling our stakes to more mainstream impact investors, which target bigger deal sizes, bigger ticket sizes. Our ticket sizes for emerging markets or frontier markets would be between 250K and potentially 2 million as follow-on investments. But then guys like Oviam and PGI, they target much larger initial ticket sizes, starting at 2 million and ranging up to 10 million.
Okay, thank you. We have one anonymous question. I'm going to read it fully. So some foundations have major conflicts of interest baked in, where foundation board members also benefit disproportionately from the foundation's asset through grants, jobs, etc. The regulator in Bern is there quite ineffective. What can be done to improve the governance for the foundation, especially over the spending? Probably a question for Sara.
I mean, maybe, I mean, it's hard to say so general what can be done. I mean, what could be always done, like if, I mean, the authority, I don't know the case now in Bern in particular, but I mean, then it's difficult, I feel. I mean, sure, I mean, if you just want to know what you could do if you're involved in such a case, I mean, the Swiss Foundation Code gives quite good recommendations, what should be followed when it comes to investments, how what kind of conflict of interest should be avoided, etc. So I think there is literature out there which you can follow. Yeah, I don't know the case with the authority in Bern, so I cannot say anything about that.
I mean, I can maybe add at Fondation Bodnar, at the beginning, there was just the foundation board. There was no management office, and all there was to define the strategy was the deed. So obviously, different board members had different interests, and we see that we have a number of legacy projects, which obviously reflects particular interests of the different board members. But governance is very important. So we have defined or redefined the strategy. We have put in place a conflicts of interest policy. So those are all, and then a strong management office with a CEO, an executive committee, then a certain process to evaluate different projects only internally, which are then only after that passed to the foundation board, to a philanthropy commission, and after that the board. So there are instruments to guard against these conflicts of interest. And if some foundation board member has a conflict of interest, is supposed to step out of an election, of a voting, of a decision process within the board.
Okay. So you've thought about this point. That's very, very good. Okay. So one maybe final question. Once a philanthropic investment is made, how do you measure progress of the entity, or do you seek influence over its strategic direction, including board representation?
So yes, board representation, potentially, maybe not us, but our partner, our venture capital or venture philanthropy implementation partner. Obviously, to influence in a good way in terms of implementing a good, strong ESG practice. And measurement is important. not only want to measure financial performance, but also impact performance, which is difficult to measure. We can measure direct outputs, for example, tons of CO2 emissions avoided, or let's say number of people getting healthcare services, or farmers touch with a certain intervention. But then the more longer term outputs or impacts on society, on incomes, on well-being is more difficult to measure, but we will put in place measurements, obviously, also potentially have a partner to do those measurements. And there are different measurement frameworks like the GIN or IRIS Plus, which are standard indicators which can be measured, that we will look at and then implement to measure the impact performance.
Okay, perfect. Thank you very much. Good. So I think we have covered a lot of topic now with good introduction. I mean, good top-down view, and then going into the very specific details of how the foundation are being run. So thank you very much to both of you. We are, of course, open for questions. I think you can still send your questions to us, and we will relate with Antoine or Sara. If you want to be put in touch directly, we will also send out a little survey, our usual survey. We'd be happy for you to give us your comments about the content of this presentation, and what you think also about other, if you have any idea for other topics. And well, with this, thank you very much to everybody. Thank you, Antoine. Thank you, Sara, for participating, and hope to see you next time.